I saved $31,000 in taxes this year with this one simple strategy that literally anyone can implement. Did you know that you can write off 80% of a value of a car in the first year if it's used primarily for business, even if you didn't pay for the car? That's right, I took out a loan to pay for the car and I still got the entire tax deduction, 80% of the entire value of that car, pretty much almost nothing out of my own pocket. And so basically I saved $31,000 on my tax bill that I was going to pay, and I'm going to show you in this video exactly how I did this. And I'm also going to show you a $14,000 mistake that I made, because this is my first time doing this, honestly, and it's pretty complex. But as I'm learning and I'm navigating and I'm making mistakes, I'm going to share all of this stuff and I'm going to tell you what I learned and how you can avoid this mistake. So I just bought a brand new 2023 Tesla Model X Plaid at the end of the year. I was scrambling because I was looking at how much money I made and I was like, shit, dude, I need to find ways to not pay so much money in taxes. And one of the most common ways is using Section 179. And so I was frantically looking for a car to buy, and I found one that was actually a pretty good deal, but because it was super last minute, that didn't go through, and I was kind of pushed to the edge to have to buy a new one from Tesla. And by the way, the car doesn't need to be a Tesla or anything like that. It just has to be over 6,000 pounds gross vehicle weight rating. Disclaimer, this is not legal advice. This is not tax advice. Go talk to your CPA. Don't get all of your tax information from YouTube. I'm just sharing with you what I learned, and I talked with my CPA before doing this, but anything is going to be super specific to you that you do for your taxes. So make sure that you talk to your CPA, and you know, this is not legal advice and this is not tax advice. All right, so I already mentioned that Section 179 in the tax code was how I was able to do this. Let me read it for you. Under the Section 179 tax deduction, heavy SUVs, pickups, vans over 6,000 pounds and mainly used for business can get a partial deduction and bonus depreciation. Typical work vehicles without personal use qualify. So in December of last year, I bought the car for $110,000. I was able to write off $88,000. So take my entire taxable income, take $88,000 off of it. I would have had to pay $31,000 more in taxes if I didn't take that $88,000 off. So let me share what I learned about taxes and writing things off. First of all of this only applies to people who have a business, who have an LLC. So if you're just a regular person with W-2 income, if you're working at Apple and you're watching this video, this probably won't apply to you. You could probably start a consulting service, right, on the side of your Apple, W-2, and create an LLC and then buy the vehicle and drive it strictly for that LLC and get away with this. Again, check with your CPA, but this is mainly applicable for people with businesses. All right, so here's what I learned when it comes to like taxes and writing things off. Of course, all of us want to pay the least amount of money in terms of taxes. Like personally, I don't want to keep paying more and more taxes. I want to be 100% legal. Obviously, I love living in this country. Everything is good. I do not want to break the law or evade taxes. I just want to understand exactly all of the tax advantages that I have personally available to me and then file taxes the right way and not overpay on my taxes. Now, one of the things that I absolutely loved about having a business is all the things that I can write off my taxes, because things that used to be normal that I couldn't write off my taxes, like any sort of travel for business that I used to do back, when I was a W-2 employee, I couldn't write any of that off. But now that I have my own business, I can write all this stuff off. But here's the problem, right? Yes, I can write all of this stuff off of my taxes. And let's say I make $1 million in the beginning of the year, taxable income, and then, expense, and I spend 500K. Now I'm left with 500K in taxable income. But here's the deal. I spent that 500K. It's not like, oh, it's a tax write-off, bro. Like, okay, it's a tax write-off, you spent the money. You no longer have the money. So I'm looking for ways to reduce my tax bill, but also not have to give away the money. I want to keep the money, at least in some form. And also, here's the problem if you show low income. So I know a lot of friends who own businesses, and basically they make $200,000 or $300,000 a year. They write off $150,000, $250,000. They're left with $50,000 taxable income, and then they can't get a loan for a car. They can't get a loan for a house. They can't get a mortgage. So I'm like, okay, bro, great. You're able to write off all of this stuff. You're not paying a lot in taxes, but you can't even get a mortgage. You can't even buy a car on a loan. You have to pay in cash, which kind of sucks. The best thing you can do is leverage other people's money to get your shit. So imagine taking a mortgage out from the bank and then getting a house, and now you just got someone else's money to pay for the house, which is an asset, especially if you put some people to live in it and all that kind of stuff. And anyways, your asset is appreciating. So that's kind of the game that I'm trying to play. I'm trying to preserve my wealth, not just spend everything and like write everything off. So my goal is very high income and also a low amount of taxes. Now there's a few ways to do this, but the one that I'm going to focus on in this video is depreciation. Depreciation, the beautiful thing about it is, let's say you make $200,000 at the end of the year, that's taxable income. If you have $150,000 in depreciation, your net taxable income is $50,000. Amazing. However, when you go to apply for mortgages or loans for cars or whatever, it still looks like you made the $200,000 because they understand that depreciation doesn't mean that you don't have that money. It means you still have that money. It's just your other assets depreciated. Now, Section 179, I believe, applies to cars, jets, and yachts. So you can open up a chartering business for either your yacht or your private jet if you can afford one, and then you can buy it. And even if you take out a loan, let's say it's a $500,000 yacht, you take out a loan for $400,000, put $100,000 down, you can write off $500,000. Grant Cardone made a video about how he bought a private jet literally last minute so he could not pay a single dollar in taxes, and he was successful in doing that. So that's the beautiful thing about Section 179, right? Is I still have my taxable income super high, I depreciate it, and it still looks like I made good income. It doesn't look like I made a very low income. The other type of depreciation that I'm looking to is in real estate. And that's, I think, where all of the millionaires and billionaires are making a ton of money, and they're buying a ton of properties because they're able to depreciate it so much while the actual value of the asset is appreciating. So it's crazy, right? You're buying, let's say, $1 million home or a $10 million building, and you're bonus depreciating, which means you're going in, you're getting a cost segregation study. They're saying, okay, all of this stuff is hypothetically needs to be replaced this year is worth $2 million. So you're writing off $2 million off of your taxes. And next year, another $2 million off of your taxes. So these people are writing off all of this money off their taxes. They're not paying taxes, and their actual asset is appreciating in value. This $10 million building is now worth 12 million, 15 million, 20 million, in 10 or 15 years. Now, here's some of the nuances of Section 179 when writing off a car. Number one, you have to buy it in that year. Number two, you have to use it primarily for business. I believe 100% for business if you want to write off the entire value. So if you drive it like 50% personal, 50% business, you can only get half of that amount. But for me, I drive it 100% for business, so I will get depreciation on the entire amount, or the 80% that I'll qualify for. And I plan on doing this again this year with a G-Wagon. So Brenny and I have had our sights on a G-Wagon, but this time I'm not going to make the same mistake that I made last time, and I'm talk about that in a second. So here's the mistake that I made. I bought the car new, and everyone knows the second that you buy a new car, you drive it off the lot, it now loses a ton of value. And anyways, if I drive the car for 6 months or whatever, put only 4,000 miles on it, it's probably going to be $10,000 or $14,000 less in value. Now, there's a person out there called PJ with Exotic Car Hacks. He created this course called Exotic Car Hacks, and he teaches people how to literally buy cars and drive them completely for free. Which means you can buy a car, let's say for $100,000, drive it, and then sell it for $100,000, meaning you essentially drove the car for free, right? You didn't lose any money. You parked your money in the car. Now, he's obviously way more of an expert than I am. I took his course, I'm in his group, and I'm learning everything around that topic from him. All right, so let me roughly summarize that course for you. Let's say you have a G-Wagon. 2022 G-Wagon has 10,000 miles on it. And let's say you have a 2021 G-Wagon with also 10,000 miles on it. At a certain point, as you go between the years, from 2022 to 2021 to 2020, as long as the car has the same miles, it's essentially valued the same. So the year of the car and the length of the car, it doesn't really matter. It's all about the mileage. Now, there's ways you can analyze this. I actually once did it manually. I went to cars.com and I built this entire chart of for a Lamborghini Urus. And I was like, okay, show me the prices for 2024, 2023, 2022, 2021, 2020, based on all of the different mileage. And so at a certain point, you'll see the lines intersect. So a 2020 and a 2021 and a 2019, all of them might have the exact same price at that same mileage. And that's where the car hack comes in. Let's say, it's a 2021 car, you drive it for a year, now it's a year later. It doesn't matter that it's a year older, it just matters how many miles you put on that car. And now here's the second part of that hack. When you buy that car, let's say that you're gonna put 10,000 miles on it. And let's say that you know that by putting that 10,000 miles, that car is gonna depreciate, let's say $20,000. What you have to do is you have to go and find a car that is $20,000 less. And of course, easier said than done. That's why PJ has an exotic car finder service and all this kind of stuff. I've never used it, but the general gist is you're trying to look for a car where the years don't matter, only the mileage matters. Buy it at a certain mileage that you know you're going to put more mileage on it, and find it at the price of the higher mileage. So whatever, get a $10,000 deal on it. And essentially, I almost did that with the Tesla, but because it was so last minute, I wasn't able to. And I'm going to take a hit when I sell the car, but at least I saved $31,000 on my taxes, and you live and you learn. Okay, guys, so that was it. If you like this style of video, I have another video that I think you'll enjoy, and it's how much I spend a month living in Los Angeles. You can see my view. It is not a little bit of money. So make sure to check it out and subscribe, guys. If you like my content, please subscribe and comment below what other videos you want me to put out. Peace.